Hey everyone, it's Julie here with TipRanks, and today we're taking a look at 3 strong buy dividend stocks that score a perfect 10. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. I hope you had a lovely long weekend. Today we're taking a look at 3 dividend stocks that score a strong buy with Wall Street analysts and have a healthy dividend with decades of payment history under their belt. On top of that, they also score a 10 out of 10 on the TipRanks Smart Score. That looks at 8 unique factors and measures a stock's likelihood to outperform the overall market. So today we're going to take a look at these companies, what it is that they do, and what those Wall Street analysts are predicting for the stock's future. I found today's companies using the TipRanks Stock Screener. Found at the top of the screener menu with the stock screener, I wanted a 10 out of 10 on the TipRanks Smart Score, a strong by analyst consensus, and a high to very high dividend yield. On top of that, I wanted a healthy payout ratio below 60%, and with those filters, it narrowed us down to just 10 stocks. You can try the stock screener for yourself over on the TipRanks website or on the TipRanks mobile app, which you can download by scanning the QR code on your screen or following the links in the description down below. Just before we get into these dividend stocks, this is a reminder that if you enjoyed the video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Now let's dive right into our 3 strong buy dividend stocks. We're going to be kicking things off with the Royal Bank of Canada. They trade under the ticker RY, currently priced at about $120 per share. In the past year, the stock has climbed over 27%, but has cooled off slightly in the last 3 months, down 2.7%. They currently score a 10 out of 10 on the TipRanks Smart Score with increased hedge fund activity and positive technicals and fundamentals. Founded back in 1864, the Royal Bank is Canada's largest bank by market cap. They operate across Canada, the United States, and 36 other countries, serving over 20 million clients with more than 100,000 employees worldwide. They offer a wide range of financial services, including personal and commercial banking, wealth management, insurance, and capital markets. In recent years, they've been exploring new avenues like cryptocurrency trading, having applied for patents in Canada and the US for crypto accounts, and back in 2022, it acquired HSBC, further expanding their asset base. The Royal Bank has a long history of paying dividends, with their first payment dating back to 1870. Back in December, they did announce an over 4% increase to their current quarterly dividend, which now comes in at about $1.03 per share for a dividend yield of 3.43%, well ahead of the sector average, and a healthy payout ratio at 46%. Their ex-dividend date is actually coming up at the end of this month on January 27th for payment on February 24th. Also, at the start of December, the Royal Bank shared their 4th quarter and full year earnings report, where they saw both an earnings and revenue beat. For their 4th quarter, they reported earnings per share of $2.13, beating estimates by 4 cents per share, and revenue came in at $4.2 billion, which grew 7% year over year. Looking at the full year, their total net income was $16.2 billion, which grew 11%. And on December 18th, we did see a 5-star analyst from Argus Research increase their price target on the stock. They said that the company remains in a strong competitive position with a growing market share in Canadian banking and a solid wealth management franchise. They added that the run rate annualized savings with HSBC are now at $400 million, which is on track for an expected total of $740 million by March of 2026. The Royal Bank stock has 11 current analyst ratings, coming in as a strong buy with 9 buys and 2 holds. And the average price target comes in at $130, implying an upside potential of 8.5%. Looking at those ratings down below, on the low end we do have a hold rating from CIBC with an upside just shy of 1%, while our high-end price target is that one from Argus at $140 for an upside of 16%. For our second dividend stock, we're taking a look at Metlife. They trade under the ticker MET, currently priced at about $86 per share. Their stock has climbed nearly 30% over this past year, and in the last 3 months is up 3%. They score a 10 out of 10 on the TipRanks Smart Score with very positive crowd wisdom and increased hedge fund activity. Founded back in 1868, Metlife now provides a broad spectrum of insurance products and operates in 40 different countries. They serve approximately 100 million customers worldwide, and their lineup of products include life, dental, disability, property and casualty, and accident and health insurance for both individuals and groups. Along with their insurance lineup, they also offer annuities, employee benefits, and asset management services. Metlife has been consistently paying a dividend for over 20 years. And their current quarterly dividend sits at $2.15 per share for a dividend yield of 2.5%, once again well over the sector average, and a very healthy payout ratio at just 27%. Their next ex-dividend date is at the start of February on the 4th for payment on March 11th. They shared their third quarter earnings report back at the end of October, where they did have some mixed results with a miss on earnings but a revenue beat. For their Q3, they reported earnings per share of $1.95, which did fall 22 cents short of analyst expectations, while their revenue came in at $18.44 billion, beating by $70 million and increasing 16% year over year. At the start of January, we did hear from an analyst at Barclays who increased their price target. As Barclays assesses the landscape for the insurance industry heading into 2025, they remain more optimistic on life insurers as they see improving free cash flow, benefits from higher interest rates, sizable excess capital positions, strong group benefits earnings, and potential for further reinsurance and merger transactions. And with 10 current analyst ratings, the Metlife stock does come in as a unanimous strong buy. The average price target comes in at $97.30, implying an upside potential of over 12%. Looking at those ratings down below, on the low end, we do have a buy rating from JP Morgan with an upside of 1.4%, while our high-end price target comes in at $104 from Jefferies for an upside of nearly 20%. You guys know the deal. If you've made it all the way to our third stock today, then this is a reminder to make sure you hit that thumbs up button. For our third dividend stock, we're taking a look at ConocoPhillips. They trade under the ticker COP, currently priced at $106. Their stock did see some ups but then downs this past year, only up 0.88%, dropping over 6% in the last 6 months, up slightly in the last 3, and scoring a 10 out of 10 on the TipRanks Smart Score, with increased hedge fund activity and insiders scooping up some shares. This oil and gas company has roots tracing back to 1875 and was the result of a merger of Conoco and Phillips back in 2002. They are an independent exploration and production company, one of the world's largest based on production and proved reserves. They explore for, produce, transport, and market crude oil, natural gas, bitumen, natural gas liquids, and liquefied natural gas globally. They operate in over 15 countries with significant production in the United States and are heavily involved in the U.S. shale plays like the Eagle Ford, Permian Basin, and Bakken Formation, with about 1/3 of their U.S. production in Alaska. They've been paying out their dividend for over 30 years and at the end of October announced a 34% increase to their quarterly dividend. They now have a quarterly dividend of 78 cents, which gives us a yield of about 3%, which is right in line with the sector average, and a healthy payout ratio at 38%. And along with that dividend increase, they also announced their quarterly results, which came out ahead of analyst expectations, plus they increased their production guidance. They reported Q3 earnings per share of $1.78, beating analyst expectations by 11 cents, and their cash from operating activities came in at $5.8 billion. Just last week, an analyst from TD Cowen initiated coverage on the stock with a buy. They said that the company's unique scale, inventory depth, and synergy targets following the Marathon Oil acquisition close set the stage for ongoing sustainable improvements in capital efficiency. They say ConocoPhillips' long lead assets, such as the Willow Project and Port Arthur, allow for long-term growth at an attractive valuation of 7% free cash flow yield. And with 19 current analyst ratings, the stock does come in as a strong buy, with 18 buys and just one hold. The average price target is $134 for an upside potential of nearly 27%. Looking at those ratings down below, we have a lot of price targets in the 20 to 30% upside. Our low end is $114 here for an upside of 7.7%, while our high end comes from Evercore at $165 for an upside of 55%. So that is a quick look at 3 strong buy dividend stocks, all currently scoring a perfect 10. Let me know your thoughts on these companies in the comments down below. You guys know I always love hearing from you. And please keep in mind these videos are never a suggestion to buy or sell any specific stock, just keeping you up to date with what Wall Street is looking at. So make sure you always stick to your own investment plan. Thank you guys so much for watching. Have a great day, and I'll see you back here next time.